Thanks for joining us here tonight, everyone. My name is Carter Dorst. I'm the Executive Director of the Kensington Conservancy. For the few people in the audience tonight who might not be familiar with the Kensington Conservancy, we're a land trust located in Ontario, primarily operating within the St. Joseph Channel, which is part of the St. Mary's River, which connects Lake Superior to Lake Huron. So we're about half hour east of Sault Ste. Marie, Ontario. So tonight's webinar is Saving Your Canadian Land for Future Generations, a special presentation for U.S. taxpayers. It is being presented by Sandra Tassel, who is the program coordinator for American Friends of Canadian Conservation. And she's also the principal author of Save Some Green, a handbook for U.S. taxpayers who own land in Canada, which was published by the Ontario Land Trust Alliance with funding from the Ontario Trillium Foundation. In just a few minutes, I'll put a link to that document in the chat so that you can all take a look at it at your convenience. Sandy has served on the board of American Friends starting in 2007, so she's been there since the beginning of the organization. Previously, she worked for the Trust of Public Land, and she's the author of the conservation program Handbook, which is published by the Island Press. So I'm going to pass it over to Sandy to take it away. Just a quick note. Please remember to keep your video and your mic off during the presentation. If you have any questions that come up, just please put them into the chat, and then we'll open it up the floor to questions at the end. So take it away, Sandy. Thanks.
Great. Hold on, just let me mess around with the getting the slideshow going. And let's see, so share my screen, do that, share, and get rid of you guys, sorry. And I'm trying to figure out how to get this to now go full screen.
Up in the top, hit slideshow. And then over at the left, play from beginning.
Thanks. This with the Zoom going, it doesn't. There you go. Except that's not the beginning. All right. So we're at the beginning. So Carter invited me to talk about American Friends of Canadian Conservation, and I definitely will get to that. But I'm going to start out not with the history that Peter and Barb and I were talking about, because that's sort of boring, but actually with all of you and your family and your land and your community and your land trust, because really the main thing I assume of interest of everybody is, how does the U.S.-Canadian tax treaty really impact the future of all those things that you care about? And I assume you care about them, or you wouldn't be spending a chunk of your evening staring at your computer screen. And then we'll get to really talking about the future. So I need you to understand that this is a super condensed version of a half-day in-person landowner workshop that I've done dozens of times. And those always had an accountant colleague generally from Grant Thornton or BDO. And so as I go through this without Grant Thornton and their binational tax experts, a number of the calculations and things that we would talk about are in here, but without them. And fortunately, we do have our own expert tonight in the form of Gail Kruk. We're very lucky as an organization to have her as our treasurer. She's a Canadian chartered accountant and a CPA in the US. And she lives just north of the border in British Columbia, and then heads up the cross-border team at Larson Groves here in Bellingham, Washington, where I'm talking to you from. And at any rate, she's a great resource and may jump in to help me or answer your questions, and is certainly available to consult with you offline as well for some of the questions that may come up tonight. So just quickly about American Friends, if you happen to catch some of Barbara and Peter and my reminiscing. This organization was created by Canadian and US conservation professionals to remove a real obstacle that to protecting some of Canada's most threatened and diverse ecosystems. And those are within a day's drive of the US border. The best estimates I've been able to find are that 90% of Canadians live and work within that kind of thin emerald ribbon along the 49th parallel. It also happens to be where land ownership by US taxpayers is concentrated. Land is expensive, it's increasingly fragmented, and it's super difficult to conserve on a large scale, as Carter will tell you. And it was really impossible without engaging US taxpayers in a meaningful way. So conservation organizations, government agencies, First Nations that were seeking to conserve land, water, species at risk, culturally, scenic, and recreationally important lands needed a tool to incentivize the gifts and interests like conservation easements from US taxpayers. And that's what we refer to as cross-border conservation. US taxpayers, like I assume most of you are, who, by the way, may or may not be American. They could just as easily be some of the many Canadians who live and work in the United States, or people from other countries who happen to live and work in the United States. But US taxpayers who are protecting priority Canadian natural heritage. So we're all using the same terminology. And I absolutely have to give you the caveats to this. I am neither a lawyer nor am I an accountant, but as Barbara was kindly observing, I've been at this for about 20 years now and have picked up a very deep level of understanding of the things that we're going to be talking about. But my real goal is to keep it at a high level so that anybody who's on the call is at least aware of the issues and opportunities. And I hope that you'll leave knowing the kind of questions that you need to ask, and ideally have enough information to initiate those really urgent dialogues, whether it's with your families or your partners or with your own financial advisors. So just think of our time together as kind of giving you the grist for both conservation and conversation, ideally. And what I'm going to do as I go along is stop periodically to ask if anybody has questions, but you're more than welcome, as Carter said, to put things in the chat. And if necessary, you know, he'll stop me if he thinks there's a question that is really relevant for everyone. And if we don't get to your questions, either through chat or by you asking and you know, interrupting, I will come back with Carter to the chat and make sure that everyone gets their answers personally, you know, after the session. So here's my plan for our time together. First of all, I've promised Carter I wouldn't take up more than an hour, including questions. So I'm going to need to kind of whip through some of this, but my goals are to give you at least a concept of what the impact of the US-Canada tax treaty is on your estate plan. And yes, that is fundamentally what we're going to be talking about, is estate planning in the context of owning land in Canada. And more specifically, why the concept of, oh, I'll just give it to my kids, works in the US, but really doesn't work with your Canadian property, and the potential costs of using that as your strategy for whether you fill in grandkids or something else there, and then knit it together with where does conservation potentially fit in to help you achieve those goals. And let me just say, I realize that your tax, legal, estate planning professionals may be totally onto the considerations that we're going to be chatting about, but I frankly have been pretty dismayed by the guidance that some families have received, and often it seems like it's from professionals who assume that if you're a US taxpayer, then they need only really look at the rules for US taxpayers, and that's where we really go awry. And I've had some very painful conversations with some very highly paid accountants and lawyers. And the thing that really breaks my heart are the conversations that I've had with heirs who want a conservation solution when it's already essentially too late to come up with one, at least not with one that's going to protect the estate from Canadian capital gains. So that's where I hope we're going to end up within the hour. So Carter mentioned Save Some Green. I know that initially he sent out a suggestion that folks download it, and I think he's going to put a link into the chat, and we can also definitely include it in future correspondence with you. The key thing is for you to know you don't have to memorize everything or ask all your questions. I'm working from this handbook in a very big way that was created by American Friends, Ontario Land Trust Alliance, with funding from the Trillium Foundation, with huge amount of knowledge that was provided by Ray Kinoshita, who was at the time really the cross-border tax guru, with Grant Thornton out of Toronto. And I would encourage you to take advantage of this resource, in part because I know how badly it was needed beforehand, and a lot of effort went into including actual examples with calculations and explanations. And you can get it on our website for free, which is pretty nice. And we definitely hope that we're going to be able to update that in the near future when we identify some additional funding for that. And with that, just so you know, you're not on your own afterwards. I'm going to dive right in. Okay, so tax primer for US taxpayers. This is a really big part of American Friends' work, and basically my personal mission is using this knowledge to protect natural lands. And it means a lot to me because I experienced that fates of a lot of really amazing property depend on this knowledge. And frankly, unless you've delved into it, it is so foreign to US taxpayers. Sometimes people don't even believe that what I'm saying is true. But I really believe that it's a way of preventing land from being sold if you understand particularly about Canadian capital gains. So the key thing that a lot of Americans, a lot of US taxpayers find really hard to grasp is that in Canada, dispositions of Canadian real estate can result in a capital gains tax liability, even if it's a gift or a bequest. And so when I say you can't just, quote, give it to your kids, of course you can give it to your kids. It just doesn't pass through your estate the way it would in the United States, because we have those, frankly, in my opinion, immense tax exemptions. So except for the most wealthy estates in the United States, very few of us have to actually consider the need for having substantial funding available in order just to receive that piece of property that mom or dad or granddad or, wanted us to have and protect. So that's the number one thing. And then we'll talk some about how gifts of land or interest in land to Canadian charities like the Kensington Conservancy, TKC, can really make a difference. And that it is possible, even though the land is in Canada, to make a gift to a US charity, but that, just like I said at the very beginning, that all dispositions trigger a Canadian tax liability. That is the case for US charities unless the charity is a prescribed donee. And so the final thing to be aware of and just keep in front of mind is that if you own land in Canada, you are going to be a Canadian taxpayer. And that's what your accountant and other advisors need to grapple with. And Carter, I'm counting on you to speak up if there's something that you've been flagged for, just so I can keep moving without watching the chat.
There's one quick question.
Yeah.
Is it still 25% capital gain tax?
I'm going to get to that and actually give an example on how where that number comes from. Whoops. So just to delve into what I was just saying, and hopefully it doesn't come across as a threat, just we've got a short time, so I'm just going to get down to the reality here. So appreciated real estate, whether it's gifted or bequeathed, is taxed as though it were sold for fair market value. So even though, unlike in the US, no money's changing hands, but the tax is still due. The only exception is for a transfer to a spouse. But on the other hand, you need to realize that that's just kicking the can down the road. And the other piece that is very hard for people to grasp is that transferring ownership just to another entity like a trust or a corporation or, for example, an LLC, which is a super common way of protecting land from estate taxes in the US, same thing, triggers the tax. So Canada has, it's basically a pay-as-you-go system. It's not characterized as an estate tax, but death is a taxable event in Canada, and it results in what's known as a deemed disposition. And so the date of death is when Canada judges that you've disposed of the property. I mean, you've can't take it with you. So I suppose that's true. But that's what makes it really challenging on these phone calls that I get from people who said, I got this great piece of land from granddad and he really wanted us to protect it. So how do I do that? You know, I don't have money to pay the taxes. So I just want to add to that I have some challenging conversations. I have for years. I used to, work for the Trust for Public Land and have done a lot of consulting with landowners. The landowners will sometimes say they're worried that if they conserve property now, that they're limiting their heirs' future options for the property. And I just would put out there that leaving a huge tax liability also has the same challenging effect for the future. And so if you do plan to bequeath your cottage or other property, this is all about a plea to make sure that you plan to make sure it's a gift that doesn't come with a liability. So let's just work through some of the nitty-gritty here. Again, this is it's an overview, and you can go back and read or talk about this later, but just like in the US, a capital gain, conceptually, that calculation is the same. It's the proceeds, except in the case of your gift or your other transfer, there are no proceeds. So you would substitute the word fair market value into that spot, and it's minus the adjusted cost base. And I am going to have a little set of numbers on the next slide to demonstrate this. And the adjusted cost base is essentially what was paid for the property or its value when it was inherited, plus any, quote, capital improvements. And keep in mind that Canada Revenue Agency wants you to be able to prove your improvements. In other words, your receipts are some other way of proving it. And that's minus your disposition costs. And the other difference between US and Canadian thinking on capital gains is there is no difference between short-term and long-term gains. In Canada, just one thing, capital gains. And here's another thing I've learned and had to think about a lot. Canada began taxing capital gains in 1972. So the cost is the value as of December 31st, 1971. It doesn't matter if your inheritance was in 1960. The actual clock started, or the value is based on that date. And there's a whole appraisal industry surrounding going back and figuring out what that value was. And I just also at this point want to tell you that I bet at least a third of the landowners I've worked with over the past 12 years did not pay the tax that was due when they, and particularly if they inherited the property after 1972. So there's a little thing for you to write in the margins of your paper to be sure and look into, at least think about. So here's the 25% number that somebody asked about and where it comes from. It's not actually a 25% tax. It's that Canada taxes 50% of the gain, and then the top combined tax rate for non-residents is just under 50%. So if you want to do your, take out your coaster and sketch out what sort of range of money you might be talking about, the 25% number is a good one to use for just for wrapping your brain around kind of the range of costs you might be needing to anticipate for taxes only. So I'm going to just show you this little sample tax calculation that my friends at Grant Thornton put together. Turns out the last one of these I did was in person was in 2019. So this one was it's gotten a little old. These are, but I checked with Gail and she assures me that at least the basic numbers are still the same. So, for example, let's say the property was purchased by the current owners in 1960. Doesn't matter. The value as of the end of 1971 would be the number that would be used for calculating the adjusted cost base. That's letter A. And for the sake of discussion, we've said that's $80,000. And let's say it's after the end of 1971, the owners put a couple $100,000 in and you know built a nice little cabin and put in utilities, and that today the value on the open market, whether it's by appraisal or by sale, let's just say it's $1 million and that it costs $55,000 to complete the disposition, whether that's in executing a transfer into a trust, or whether that's settling an estate, or whether that's a commission, disposition costs. And so you just subtract, you've got the math right there, C minus A minus B minus D. And this particular property has a capital gain of $655,000. And our friends at Grant Thornton did the actual calculation, which in this case, I think turns out to be about 24% because the tax is graduated. So in order to give this property away or for somebody to inherit it, they have to spend about $190,000 to have figured out all of the disposition costs and to have paid the Canadian capital gains in order to have clear title. So I'm going to stop there. I see there are some questions have come up. Carter, maybe you could help me gauge if those are questions that would kind of help everybody.
There's no necessarily questions at this time, just some chat going on.
Okay.
We'll address later.
Okay. Well, let me just stop for a second, and I've got my screen at full screen, so I can't see people to see if they're raising their hands. Can you just check to see if there are folks who would like to look at this a little more carefully or discuss any particular point?
The one question just came into the chat. What are disposition costs?
This is a made up number in this case. So it could be legal fees. You might have a survey. It could be your appraisal. Very much could be, it's probably not enough to be a full commission. But legal fees can definitely add up, document preparation. If it was in the case, and actually I don't know, I know in the US that you can write off your stewardship, but all of those costs that can be attributed to the actual transaction. And it's going to be different whether it's in a will or whether it's a legal, you're setting up a title in another entity or selling it on the open market. And I'm going to trust that if Gail has something, she's going to unmute herself and speak up.
So yeah, I'm not seeing any other questions at this time, so I think you can proceed.
Okay. So I see that the person asked are the legal and transfer costs deductible, and they are, because they're being taken off of the capital gain. The capital gain excludes those actual costs. No, why are you not moving? Oops. So the idea of how to be planning for the future of your land, the number one thing is to realize that the treaty between the US and Canada, one particular piece of it, says that the country where the land is located is the one that gets first shot at capital gains. And so that was why I earlier had said, if you own land in Canada, you are going to be a Canadian taxpayer. And that that you need to plan for the fact that there is very likely going to be a tax due even on your gift. And my understanding from talking to folks in your area is that land has appreciated substantially, maybe not quite like Georgian Bay, but to realize that the tax is going to have to be paid in order to transfer the ownership. And so if you want to pass the property, whether it's a cottage or whatever it is that you own in Canada, and there are plenty of other kinds of taxable Canadian property. I'm only talking about real estate, that you need to both be sure that the funds are available to pay the tax. And no offense to your heirs or to you, but definitely consider whether your heirs, your colleagues, your friends, whoever is going to be stewarding and enjoying that property in the future, that they are going to spend that money to pay the taxes. And that's of course not counting on anything for maintenance and property taxes. And so just grappling with this question of, do you need to consider other steps, such as possibly placing a conservation easement on your property that protects the natural values of the property? And yes, it reduces the Canadian tax burden, but it also will make sure that the future of your property is the future that you're hoping for, as far as the maintaining the natural heritage of your area. And this is way too complex to get into tonight, but something that maybe we'll talk about some other time.
Sandy, it's
yeah.
Gail.
Hi, thank you.
Yeah, I guess the other thing I just wanted to mention is, the other issue is, if you transfer the property into a trust, Canada has a rule, we lovingly call it the 21-year rule, which means every 21 years, a trust is deemed to have sold all of their assets. They're required to pay the capital gain and revalue the property. So even if you put it in a trust, you think, okay, I've had this one-time tax and it's going to protect me forever, because usually U.S. trusts
Right.
are perpetual. In Canada, every 21 years, you still have to revalue the property and pay tax on any deemed gains. So trusts are not always the best option if you're trying to keep this for generations and avoid paying tax. So I just wanted to put that up.
Yeah, thank you very much for bringing that up, because that is such a different concept again from the US, and I was sort of referring to that when I said that Canada uses a pay-as-you-go system, and that's a great example of it. Yeah, I mean, at some point, it's better to stay up to date on the taxes, but it also means that there's using the trust that you've created another potential for future liability, which is a great reason to use conservation. So thank you. I'm going to use that. I'll make that my entree to the next slide.
So Sandy, there's
yeah.
a question, two quick questions related to that. First is back to paying the taxes. Is each generation has to pay the taxes upon transfer? And then there's a question, is the 21-year rule the same for LLCs?
I think, well, the problem with LLCs is that it's, and Gail, please feel free to drop in and help me here, but the LLC is not a recognized form of corporation in Canada. And yeah, Gail, you want to field that one?
Sure. I mean, the LLC for Canadian purposes is considered a corporation. So it doesn't have the same 21-year rule. I mean, if it's in a LLC, it's going to be, it's in there for perpetual, I guess, perpetuity, I guess is the word. But it does create some further complications because Canada considers it a corporation. And now you have a personal use property in a corporation. So it's not, we generally try to avoid LLCs in the cross-border realm. And I would just answer Stephen's question. I would say, yeah, every generation has to pay taxes upon transfer. There's no avoiding. That's the second question.
Yeah. I mean, unless Canada changes its capital gains, at least what we know now is that every transfer is going to incur that tax. So conservation and how it can help. Protecting your property obviously saves the land and potentially can reduce Canadian capital gains taxes. I mean, the basic concept is that if the future uses of a property are limited, then the value is reduced. It's that, if your property is such that it could be currently subdivided into 4 parcels, and you decide that for both the sake of your property and nature and water quality, that you really want to only have the one cottage on it, then you can use a conservation easement to reduce the amount of potential development in perpetuity, and therefore the property is going to be worth less and your gain is going to be reduced. And you can do that during your lifetime, or you can do it through your will, but you have to be sure that it's done before you die. So it's too late if you've passed away and your grandkids want to say, okay, well, now we'll put that easement on it. So you can also protect, depends a lot on how much land you have and so forth. But you can protect through a gift, or I don't know if TKC does actual purchases. So we'll be talking about the idea of working with a qualified Canadian charity such as TKC. And we're going to talk quickly about the ecological gifts program, or you can make a gift, again, either of the land or of an interested land, like an easement, to a U.S. qualified charity that's a prescribed donee, which is what American Friends of Canadian Conservation is. We're going to get into that. And I just want to stop and note that TKC has a U.S. charity. Probably many of you make your donations to it. But because it's a U.S. charity that is not recognized as a prescribed donee, a gift to it triggers the Canadian capital gains tax the same way it would be triggered if you gave it to your house sitter. It's a real it's a point of great frustration, but that's why American Friends was created, so that there would be an entity that could accept gifts of land and avoid the Canadian capital gain. And we're going to delve into that in just a moment. And then I'll stop again for questions. So right now I'm talking about Canadian charitable gifts. So this is all about what might happen if you work directly with TKC, and that may turn out to be the best option for you and your family as your estate planning tool. So a gift to TKC will generate what you call a Canadian tax receipt. We would call it probably a tax deduction. And if you have Canadian income that you declare on your U.S. tax return, the Canadian tax receipt can offset that. But the really good program, really much better than the U.S. approach, is what is called the Ecological Gifts Program. And I've got a slide coming up that's going to get more into it, because gifts through the Ecological Gifts Program are not subject to capital gains and can generate a tax credit. So it's much better than a tax deduction. And those credits can be used to offset, even potentially completely, the capital gain on other taxable Canadian property. And Carter, I'm assuming that TKC is a certified eco-gift recipient. Is that correct?
Yeah, we are.
Okay, I figured you must be. So let's just take a quick look at these donee options, and then I'm going to when it makes sense to make a gift to the Canadian qualified donee. So on our discussion, we're going to assume we're talking about TKC. So one example I gave, if you have Canadian source income, and that includes capital gains, you could use the Canadian tax receipt. But you need to realize that the gift to TKC, if it's not going through eco-gifts, is going to trigger the capital gain. So you would be using your tax receipt to offset the capital gain. So it ends up being kind of a zero-sum game. And luckily, there are a lot of generous US taxpayers who love their properties and have made gifts of land or easements to land trusts all over Canada. Sometimes they just don't have the US income to utilize a US tax benefit, or they don't want to pay, because there are additional costs to have the transaction that meets both countries' rules. And if the appraised value of the gift is likely to be under 200,000 Canadian, it becomes really hard, at least if the landowner is paying all the costs. It just becomes hard to make the numbers work out. And then I also want to point out that if you're giving a conservation easement, it's important that the Canadian recipient be recognized by the IRS as a foreign equivalent of a 501c3. And Carter, I should have asked you before. I'm sorry. I doubt that's the case, but does TKC have that recognition? Silent. Probably not.
I don't think so.
Yeah, I wouldn't think so, given that you already have a US charity, but it is an important consideration. I'm not going to delve into that, but I just want to flag it because it is a consideration for US estate tax reasons. So put that aside, and then we'll talk about that another time. So here's the scoop on eco gifts. And a lot of times the US taxpayers think, well, I'm a US taxpayer. Why would it be useful for me to make a gift that results in a Canadian tax deduction? So first of all, you need to realize this is only for ecologically significant land, and you'll need to talk to Carter and to find out if your property would even meet the guidelines. So you've already got but the Canadian system, because the government was encouraging the protection of ecologically significant land, there is no Canadian capital gain tax on that conservation donation. And you're kind of double dipping because you get the income tax credit. And that can be super helpful for a US taxpayer who has other Canadian property. If you want to read a really good example of this, we'll put the link, send you the link, but there's a story in our current version of Among Friends, the annual publication of American Friends, of a family in the Thousand Islands who did an ecological gift. And it completely offset the capital gains on sales of property and the transfer of other property to the next generation. It's fantastic. So not all US taxpayer conservation activities have to go through a US organization. I mean, we want to help you, but we don't want to help you if you don't need us. So, and then I also thought I would mention this because Peter Wells and I have talked for years about how to get land out of corporations, because apparently a number of families put their land in the North Channel into corporations a long time ago. So theoretically, you could do an ecological gift and actually put an easement or donate some of your acreage to create that tax credit, which would cover the capital gain of shifting the ownership either into the individual names of people, or to cover it going to the next generation. So I've been accused of being a deal junkie. So if you want to talk about how that would work, we'll also do that offline. And I don't see any more questions in the chat, but I'm going to stop. Yeah. Let me just stop there for a second. I'm watching the clock. Do you see anybody with their hand up or other questions coming in, Carter?
Nothing right now, no.
Okay. All right. Then I'm going to explain what a prescribed donee is and why you should care. So the Canadian government created a category in the Income Tax Act, and historical factoid, it was brought into being when the Nature Conservancy in the US was working on protecting land in Canada. This is like, it was before NCC, the Nature Conservancy of Canada, was active. And so it's kind of an artifact of basically in the Canadian Income Tax Act. So the Nature Conservancy in the US is a prescribed donee. The Nature Conservancy of Canada has a US charity that is a prescribed donee. And the other one is American Friends of Canadian Conservation, which used to be American Friends of Canadian Land Trusts. And it creates an incentive for US taxpayers to protect their land in Canada. It's essentially like eco-gifts for US taxpayers. It's not quite as good, but there is a mechanism by which the capital gains tax liability can be eliminated on the gift. And then there's the US tax benefit because the land or easement is gifted to a US charity. And American Friends of Canadian Conservation is the only prescribed donee that was created solely for the purpose of helping other entities. And we started out as the American Friends of Canadian Land Trusts, but we can work with and have worked with government agencies, and we've already taken several runs and we've been working with a First Nation in New Brunswick, and look forward to expanding that knowledge and skill in the future. Kind of just covered this, but yes, those are real people involved in real American Friends projects on the right-hand side. So American Friends is a 501c3. It's a publicly supported charity recognized by Internal Revenue Service. It's also a Washington State not-for-profit organization. That's where I'm talking to you from. Canadian prescribed donee. So it's not an eco-gift organization because you have to choose one or the other. Eco-gift recipients must be Canadian charities, and American Friends is the alternative. We don't work on our own. All of our projects involve a qualified Canadian partner, which the Kensington Conservancy recently became, and that's because the local partner is the boots on the ground. We don't aspire to have people all over Canada doing monitoring easements and managing land. You have a fantastic organization right there that has that mission. So we're working to support the local organization's mission. I have a note there that under US law, American Friends cannot operate as a quote pass-through. And that's note is there just to be sure that you understand that land that's donated to American Friends is actually held by American Friends, same with easements, and that it's a completely separate transaction to the Canadian partner. And that is a requirement in order to make sure that the tax actual deduction goes to it's only good because it's a gift to a U.S. organization. And I updated these numbers today at the bottom because we just recently had a closing, which was great, which pushed us over 4,000 acres of land, and that's been appraised at just a hair shy of $19 million US. So it's definitely a going concern, and we've helped a lot of land trusts in 6 provinces protect land that's owned by US taxpayers. Just a few notes to just zero in on the function and how it works. The property has to be a priority for a Canadian partner because they're the ones that manage it or monitor it in the case of an easement. It's a donation to American Friends, and therefore it's tax deductible. And we also have to make sure it meets Canadian requirements. And that's the knowledge that we've accumulated. And as I mentioned, our goal is to get the ownership or the conservation interest to the local partner for the permanent conservation. And so for some people, it's, for some Canadians, it's also really moving, really valuable, because eventually the land is repatriated to Canada, and there are definitely parts of Canada where that's, well, maybe all of Canada, where that's a really important feature of our work and a good outcome. So these are, by the way, almost all pictures of properties that we've protected in Ontario. This is Old Man's Creek in the French River Drainage, a partnership with Magnetawan Watershed Land Trust. So just to give you a sense of why our donors do decide to make a gift to American Friends, this admittedly is using a pretty high number, but the appraised value of the gift is what the U.S. tax deduction is for. Certainly the entire deduction isn't at the top marginal tax rate, but it can be a very significant amount of money. And there are a number of states that also honor charitable deductions, and that where there's an additional tax benefit from, and that can be federal tax can be carried forward for 5 years. So it's the year of the gift plus 5 years. So even if a donor doesn't have the income to use the entire benefit in the year of the gift, there's the option of using it against future income. And then very briefly, hopefully most people have at least the basic idea of what a conservation easement is. I'm just going to say that it's like donating your development rights. It's looking at restricting in perpetuity the future uses of the property. So the more that you voluntarily decide to restrict the future uses, the more impact it's going to have on the value. And so you have the value before the easement. That's what it would be worth if you sold the property on the open market. And then there's a value after the easement where the appraiser looks at how much less could the property sell for today with those restrictions in place. And the difference, call it before and after, is the amount of the charitable deduction. And again, the actual top marginal rate isn't going to be the rate at which the entire gift is evaluated, but there is a substantial federal tax benefit. And remember, this is also reducing the market value of your Canadian property, so that if you were, for example, going to give it to whoever your heirs are, you've just greatly reduced your exposure to Canadian capital gains because the value has been reduced. The other interesting thing about conservation easements is that there's a much longer deduction carry forward in the United States. It's 15 years instead of 5 years. And I won't wade into how that happened, but it might be a useful thing to know if you're doing longer term planning. So I guess this is the really true marketing piece, I guess, or, what we do and when you need us. If the landowner needs a U.S. tax deduction and doesn't have a reason to, other property that they're disposing of that would trigger a Canadian capital gain, and then it has to be a priority for TKC. And generally, we'll be looking at a property value over 200,000, just so that the numbers pencil out for the land or easement donor. And then for the sake of transparency, there are extra costs, and there needs to be a source of that funding, not just for the actual initial gift, but also to make it possible for the property or the easement to be transferred later to TKC, because there'll be a whole nother set of legal fees and registration costs. I'm almost done, and we can get right to questions, because I see there are there's some more chat going on. So this is just a really quick summary of the donee options. We talked about a gift to a Canadian charity, that would be TKC, and that's helpful because there's no Canadian capital gains tax. Well, there's a mechanism by which the gift, the tax receipt, offsets the capital gains, but no U.S. income tax benefit. Gift to a U.S. charity that's not a prescribed donee, you're welcome to give it to the Minnesota Land Trust, or I'm not sure who your nearest, to Audubon, Michigan Audubon, but it's going to trigger a Canadian capital gains tax if you've got a capital gain. But on the other hand, there would be a U.S. income tax benefit. And then with American Friends, there's a mechanism by which to eliminate capital gains taxes on the gift and generate the U.S. income tax benefit. So in conclusion, he's just the cutest kid whose parents gave land in BC. Grandparents. US taxpayers can protect their land through a gift of land or conservation easement at TKC or American Friends. You'll need to evaluate your goals, the value of the tax benefits, and overall finances to determine which approach is the most useful. A gift of fee title, that's ownership, and that could be not all of your property. If you have a large property, you might be able to divide off an ecologically sensitive piece and protect that and keep the other. Or the idea of a conservation easement can reduce, offset, or even eliminate Canadian capital gains taxes, particularly if you're working through the ecological gifts. And I'm going to close by just encouraging you by saying the timing is super critical. Don't put it off because death is a taxable event in Canada. And definitely get experienced professional cross-border tax and legal advice to help you make those decisions. So Carter, what do you see in the chat? Are people putting up their hands or?
So yeah, there's one question here. Excuse me. 15 carry forward in Canada, 5 in the US.
No, 15 carry forward in the US for conservation easements. It's different. The gifts of ownership only carry forward 5 years, 15 years for easements. And Carter, correct me if I'm wrong, but I believe for an eco gift, it's 10 years.
Yeah, that sounds right. Yeah.
So there's actually 3 different carry forwards to consider there.
Okay. So if anyone else has questions, Sandy, maybe if you want to stop sharing your screen so we can get everyone.
Yeah, I'll do that. But let me just show you that there's when we share, I'll send out a PDF of this and it'll have links to Save Some Green and also to the Ecological Gifts Handbook, which if you're considering using that approach, that would be a really important next step for you to study.
So feel free to unmute yourself, turn on your video. I see Barb here has her hand up to say something. So go ahead, Barb.
Yeah, I'm curious, Sandy, is there a case study where a family has donated a sort of intergenerational property through American Friends? It has, for example, a cottage on it, and they have signed an agreement when that land is being donated to a Canadian recipient that they can continue to use that cottage for a set period of time or in perpetuity. And then people can die happily and not have to worry about all of these tax implications, or is that considered a pass-through or something like that?
Well, that's a really great question because it comes up a lot. We, as a rule of thumb, have not accepted properties with cottages on them, and instead, at least so far, it's been feasible to subdivide the property so that the cottage is on its own lot and therefore not part of the gift. And part of the reason for that, Barb, is that the US charitable system makes it a lot harder to work through any kind of reserved right. And also the prescribed donation status is specific to ecologically significant property. So having a building on it definitely complicates it. So those are the reasons and the way that we've avoided it so far and have encouraged people to keep the cottage on a separate lot, if that's at all possible. And if we come to a situation where we can't do that, well, we'll, as my dad used to say, burn that bridge when we get to it.
Okay, thanks.
You bet.
So there's a question in the chat here about just our most recent most recent acquisition, the Gravel Point Preserve, if it was an ecological gift for the donors. So the answer is no. Technically, the Gravel Point Preserve is 4 separate lots. They were all owned by US taxpayers. What happened is technically we purchased 3 of them ourselves. And then the one that was donated to us, the property wasn't worth very much, and the donors decided not to go through either of the programs and just donate it outright to TKC, and then they would have had to pay any taxes that they had to pay on top of it.
Right. Good. Yeah. Good example. Sometimes just the market value just makes it not make any sense to go through.
Yeah, the property wasn't worth very much, and when you have to pay money to go through either American Friends
Yeah.
or Eco Gifts, the tax benefits, it's not worth all the extra work, and it's just in their best interest just to donate it outright to TKC. So that's what happened there. And Joni has her hand up.
Hi, Sandy. You're brilliant at explaining this, and
Oh, hi, Joni.
and TKC for holding this incredible evening. I just have a quick question. If you could explain again about the 200,000 kind of limit of making it work. I can never remember what that is.
So it's just again sort of a back of the envelope calculation. I figured out years ago that it's very difficult to get the costs of a donation to American Friends under 25,000 total. It's the appraisals are expensive. There's the you have to get the CRA to issue the certificate of compliance. American Friends has a transaction fee. So if the landowner is paying all of the costs, then it's hard to make it pencil out if the deduction is under 200,000. It just doesn't make financial sense. The flip side is that if the land trust or other, if other sources are available to pay those costs, for example, we did a transaction with the Bruce Trail Conservancy. The property appraised for, it was like 137,000. But Bruce Trail Conservancy was delighted to get a really key property for basically cost them $20,000 instead of $137,000. So I put that in. That 200,000 is pretty arbitrary, but it's just to kind of get people thinking about who's paying and when it's being paid, so that they can factor that into the decision making.
Thank you, Sandy.
You bet.
So does anyone else have any other questions? Oh,
well, I just wanted to say thank you. This is great.
Oh, great. I'm glad that was helpful.
It just tells me how much I need to read up on.
Well, we jammed an awful lot into a short period of time, so I'm glad to see that your head isn't screwed on backwards now. It hasn't exploded yet.
This will be
Right.
made available later, will it? The entire slideshow and everything.
Yeah, it's being recorded. So probably tomorrow at some point, I'll send out an email to
Excellent.
everyone who registered with a link to it and the slides and more information and whatnot.
Thanks so much, Carter. That's great. It's been terrific.
Oh, good. I'm glad. And yeah, I know it's going to give people a lot to think about, but that was kind of Carter and my goal was let's get it out there. So at least get people pondering what it might mean for them and their family and their property and TKC.
Peter, do you have a question or
No,
comment?
I wanted to say, thank you, Sandy. This was great. And thank you, everybody, for, sitting in tonight.
Yeah,
Just
thanks.
one quick question, Sandy. Do we have case studies written up on sort of each of the various scenarios that you've described? That would be very useful.
The in the back of Save Some Green,
Yeah.
they're invented case studies, but that I made up in order to really demonstrate the concepts. And there are a number of, I suppose you could call them case studies that have appeared over the years in among friends, like that one that I was just talking about in Thousand Islands. But they don't have numbers in them. They're just explanations of why people did things and a little bit of technical information about how it worked. So yeah, if you think some real case studies, let's put it on the list if you think that would be valuable.
I think that a lot of people, at least I do anyway, I learned from going through someone else's experience and
Yeah.
that would be helpful. Yeah. Yeah. Thank you.
Thank you.
Okay, yeah, thanks a lot, Sandy. We really appreciate
Yeah,
it.
you're welcome. Thank you.
That was fantastic. For those who are still on the call, just our next webinar is going to be late March and it's going to be all about volunteering with TKC. So if that interests you, stay tuned, watch your emails tomorrow. An email will be going out with registration for that. So thanks again, Sandy. We appreciate
Yeah,
it.
you're very welcome. I appreciate the opportunity. All right. Have a good night.
Have a good night,
Time to
everyone.
time to walk the dog.